Something just broke in the US bond market, and almost nobody is paying attention. This should not be happening. For decades, bond yields have followed a simple rule. When the Federal Reserve cuts rates, everything moves down together. But right now, that rule is breaking. Short-term yields, like the 2-year Treasury, are falling, signaling rate cuts are coming. But long-term yields, like the 30-year, are staying high. That's not normal. That's a disconnect. Think of it like this. The short-term market is saying, the Fed will fix things, but the long-term market is saying, we don't trust the future. And this is where most people get it wrong. They focus only on Fed policy, rate cuts, quantitative easing. But that's not the real story. The real issue is long-term confidence. The US government is issuing massive amounts of debt, trillions, every year. And investors are starting to ask, who is going to buy all of this? When uncertainty rises, investors demand higher returns. And that pushes long-term yields up, even if the Fed is cutting rates. And this is where it gets serious. Long-term yields control mortgages, business loans, and borrowing costs across the entire economy. If they stay high, everything stays expensive. There are only 2 ways this can go. Either long-term yields fall, meaning confidence returns, or they stay high, and the pressure continues. Moments like this are rare, because the bond market is usually stable. When it starts sending mixed signals, it's not random. It's a warning. So the real question is the bond market overreacting? Or is it seeing something the rest of us don't? Subscribe to Quantara Finance and understand the system before it changes.